Welcome to This Explainer. Okay, let's just dive right into this. When you're sitting in an accounting lecture, it's honestly incredibly easy to view standards like ASB 119 as just another dry set of rules you have to memorize to pass an exam. But today, we're going to look at this standard through a completely different lens, your very own future. We're going to decode the accounting rules behind the actual benefits you'll be negotiating when you land your first big job. We're fully adopting the student perspective today. We're translating abstract accounting liabilities into the very real roadmap of your future career. Think about it for a second. Have you ever wondered how your future employer actually tracks your sick leave? Or why they might offer one type of retirement plan over another? Well, behind every single perk, bonus, and leave balance you'll one day receive, there is a corporate accountant meticulously tracking the liability. So here is your syllabus for mastering this topic. First, decoding the ASB 119 scope. Second, short-term employee perks. Third, post-employment benefit plans. Fourth, the defined benefit four-step process. And finally, long-term and termination benefits. We're basically following the chronological arc of an employee's life cycle, from your daily wages all the way to retirement. Let's start right at the beginning, decoding the ASB 119 scope. Employee benefits are a massive, massive expense for any entity. And this official definition, it covers everything from formal workplace agreements to payments made to dependents. The absolutely crucial phrase to remember here is all forms of consideration. That means we aren't just talking about your standard cash salary. If an employer gives you literally anything of value because you worked for them, whether that's health insurance, housing, a company car, or even a payout when they let you go, it falls right under this exact definition. Now, you're going to want to anchor these four categories in your mind because they form the exact structure of how employers must legally classify what they owe you. They beautifully illustrate how the standard organizes an employee's entire life cycle. First, you have your short-term benefits, things settled within 12 months like wages, then post-employment benefits like superannuation. After that, we look at other long-term benefits like long service leave, and finally, termination benefits, which are a totally unique beast. If you can memorize these four buckets for your exams, you have already conquered the underlying architecture of the whole standard. Moving right along into the daily grind, let's talk about short-term employee perks. For your exams, you absolutely must remember this measurement principle. Because short-term benefits are paid out quickly, employers record the undiscounted amounts, matching the expense to the period you worked. Let's think about why that matters. Accrual accounting says we need to match the expense of your labor to the exact period you provided the service, right? But because these short-term benefits are settled within 12 months, the time value of money just isn't a huge factor. So accountants actually get to keep it pretty simple. They measure the liability at the undiscounted amount they physically expect to hand over to you. Notice the stark contrast here. Non-accumulating leave is only tracked when it happens, whereas accumulating leave builds up as a liability for your employer every single day you work. Guys, this is a classic exam trap, so pay close attention. If you have sick leave that you lose at the end of the year if you don't use it, your employer doesn't owe you anything for it at year end. They only record it when you actually get sick. But annual leave, that accumulates, you can carry it forward. So every day you work, you earn a tiny fraction of that leave, and your employer has to record that growing liability on their balance sheet. Now, what if your future boss always pays a Christmas bonus? Well, they actually have a constructive obligation to recognize it as a liability, even if it's not written into a legal contract. This is such a fascinating concept for anyone entering the corporate world. You might not have a piece of paper legally guaranteeing a profit-sharing bonus, but if the company has a massive, reliable history of handing them out every December like clockwork, they've created a valid expectation. Under ASB 190, they realistically have no alternative but to pay it. Therefore, an expense and a liability must be recognized. No way around it. All right, let's look at the long haul. Section 3, post-employment benefit plans. Think of this as the ultimate who bears the risk matrix. With a defined contribution plan, your retirement depends on market returns. But with a defined benefit plan, the employer guarantees the payout regardless of fund performance. Under defined contribution, your employer just pays a fixed amount into a fund like standard superannuation. If the stock market crashes, honestly, that's your problem. But under a defined benefit plan, your payout is based on a specific formula, usually your final salary and years of service. So if the fund's investments tank, the employer legally has to step in and make up that shortfall. Now, defined contribution is relatively straightforward for accountants, but note this. Australian entities must specifically use the corporate bond rate to discount these liabilities. The accounting is pretty logical. You work, the company recognizes a contribution expense. If they haven't transferred the cash yet, liability. If they accidentally paid too much, asset. But the major trick to highlight for your exams is that last point. In Australia, when discounting post-employment liabilities, you have to use the corporate bond rate, not the government bond rate. Definitely tuck that away in your memory.
Moving into the complex territory. Section 4. The defined benefit four-step process.
Because the employer takes on the massive liability of investment risk, tracking defined benefits requires this strict four-step process to calculate the exact obligation. You literally cannot just guess these numbers. Step 1 requires finding the deficit or surplus by taking the fair value of the plan assets and subtracting the present value of the defined benefit obligation. Then, Step 2 adjusts that into a net liability or asset, checking it against something called the asset ceiling. Finally, the real heavy lifting begins in Steps 3 and 4, where we route different parts of this changing liability to totally different financial statements. To organize where everything goes, remember this visual cheat sheet. Routine expenses like service costs and interest hit profit or loss, while actuarial swings and plan returns bypass it entirely to land in OCI. What's really brilliant here is how the standard separates routine business expenses from completely unpredictable market swings. Things an employer can somewhat predict, like the cost of your current service, go straight to the P&L. But remeasurements, like actuarial gains because people are suddenly living way longer or wild swings in the stock market, those go to other comprehensive income. This essentially prevents massive, unpredictable market swings from absolutely destroying a company's reported net profit for the year.
Finally, let's cover the later stages of the employee life cycle in Section 5, long-term and termination benefits.
So an employer doesn't just wait 10 years to record your long service leave. They actually have to measure it continuously as it accrues, using 4 predictive steps. Imagine you get 3 months of paid leave after 10 years of service. An accountant can't just ignore you for 9 years and then take a massive expense in year 10. They have to estimate how many staff will actually stick around that long. Then project what your salary will be 10 years from now. Next, figure out the accumulated benefit to date, and finally, measure the present value using the projected unit credit method. It's this mathematically complex accounting that happens entirely in the background while you're just doing your daily job. Now, unlike everything else we've discussed, termination benefits are triggered by the act of letting you go, meaning the liability is recognized when the offer simply can't be withdrawn. This is absolutely crucial to understand. Every other benefit we've talked about, wages, annual leave, pensions, is an exchange for your service. You work, the liability accrues. But termination benefits? Completely different. The obligation doesn't arise because you worked hard. It arises strictly because the company is terminating your employment. So the employer only recognizes the liability at the earlier of 2 dates, when they can no longer withdraw the offer, or when they recognize related restructuring costs. So as you master AASB 119 for your exam, ask yourself this. How will these strict accounting rules shape the actual perks and pensions you'll be negotiating in your very next interview? Understanding this standard isn't just about passing a test, It's about looking at a job offer and knowing exactly how much risk your future employer is taking on to keep you and how much risk they're passing right back to you. When you sit across from that hiring manager, knowing how they have to account for your benefits gives you the ultimate edge. So will your next job guarantee your retirement or just contribute to it? Keep that in mind as you study. Thanks for joining me on this explainer, and I will catch you in the next one.